Hello, everybody. This is Chuck Carnevale, co-founder of FastGraphs, the fundamentals analyzer software tool, aka Mr. Valuation. Today, we're going to kind of do a relatively deep dive into a very high income vehicle, Enterprise Products Partners. It's a midstream master limited partnership, and its primary reason for investing is for high current yield, but also because they've grown their dividend consistently for over 21 consecutive years. But being a master limited partnership, there are some issues that need to be considered for anyone investing in it. But if you're really looking for high income and you're looking for income growth, plus ability to make a little bit of profit down the way, then a master limited partnership like Enterprise Products Partners could be just a ticket. Now, it does come with some tax issues and consequences that would need to be examined with your accountant, but I'm going to look at it from strictly the investment point of view and not look at it from a standpoint of taxes. So let's go ahead and get into the fast graphs and let's kind of take kind of a deep look at Enterprise Products Partnership. Now, the first thing I've got on the graph here is adjusted operating earnings. And this does provide a nice perspective for the company. So I'm going to take weekly closing prices off of the graph, and I want you to focus on two things. These are operating earnings. Now, I have the ability with fast graphs to also look at basic earnings, which are very, very similar. And I also have a look at diluted earnings, which includes all the accounting convention. And you'll notice in this particular case, they're very indistinguishable from each other, really. But just some nuances of accounting convention involved. Okay, but earnings don't necessarily cover the dividend. I want you to notice that their dividend payout ratio relative to earnings has been over 100% in many cases. Now, what I want to point out about that and talk to you about, master limited partnerships have a very unique capital structure, okay? And their business model is based on long-term contracts that actually generate stable cash flows. So what you really want to do when you're looking at a master limited partnership like this is go into the cash flow correlations because they become significantly more relevant and important. As a master partnership, the company is required to distribute available cash on a quarterly basis. And the particular sector requires companies to raise both debt and equity capital to fund their growth while maintaining these distributions. That's another thing you should take into consideration. But free cash flow to equity is how I normally look at dividend safety for companies. But when you're looking at free cash flow to equity for something like a master limited partnership, like Enterprise Products, you'll be disappointed because very rarely the gold line on this graph is the dividend line. The orange line here is free cash flow to equity on this iteration. We're looking at free cash flow to equity. And you'll notice the dividend isn't covered. But operating cash flow is covering the dividend just really universally. Now, there was this big spike coming out of the Great Recession of '08 and '09 where the company's cash flow spiked up. It had to do with acquisitions and some other issues. But I do want to make a point. The reason you don't see the free cash flow to equity that I just showed you a minute ago covering the dividend is because the capital intensive nature of a master limited partnership. Okay, now they're actively investing in organic growth, which is new processing plants and pipeline systems. They're also making acquisitions quite frequently, including additional pipelines and so on. And again, I'm going to let you go through that kind of detail yourself. But they also have raised some debt, and we'll talk about debt here a little bit later. And the company also periodically will issue some stock, but this company has been able to maintain their distributions. They've increased their dividend, I believe, for 21 consecutive years, and they did it without issuing a lot of stock, which is good, but they have taken on some debt. As you can see, their long-term debt to capital is 48.41%, but they do get an A- credit rating from Standard & Poor's because they do have a relatively strong balance sheet. Okay, so the reason why, again, free cash flow, just to reiterate, free cash flow doesn't cover the dividend on this master limited partnership is actually a function of several things. Number one, the company must be constantly assessing capital markets for funding. That's a nature of the beast here. The business model also requires continuous investment in infrastructure and maintenance. They've got to continuously be maintaining their pipelines and, again, continuously adding to their pipelines to keep their income growing. Okay, so from a standpoint of distribution, their structure requires that they pay regular quarterly distributions. And they have maintained for, as I mentioned earlier, over 21 consecutive years of distribution growth. But that also creates pressure to maintain and increase these payments. Okay, now the industry characteristics, the mainstream energy sector requires significant ongoing capital investment, as I already mentioned. While cash flows are stable, they may be committed to capital projects rather than available to distributions. So when you look at operating cash flow, you can see that it's been pretty stable and it's been highly covering the dividend. But you also will see EBIT covering the dividend in most years. And then, of course, EBITDA, which includes earnings before interest, taxes, depreciation, and amortization, where you have the dividend well covered. But of course, and when you start adding in depreciation and some of those other accounting conventions, that gets a little different. But this company has obviously is a very strong producer of cash flows. Okay, now if you look at the company with stock price now overlaid on their operating cash flow, I do want you to note, just like it is with earnings for most companies, the best time to invest in stock like this, especially an income vehicle like enterprise products or a master limited partnership, is the price to EBITDA or price to operating cash flow. Let's actually look at operating cash flow instead of EBITDA. When the price to operating cash flow is low, like here we're looking at '08 coming out of the Great Recession where the price had dropped significantly, we were able to buy this price to operating cash flow at 4. The price to operating cash flow today is about 8. Okay, 8.21. That's the blended price to operating cash flow. So we got about 8% growth. We got good distributions. This was a great time to invest in this company. It generated an 11% total rate of return, an annualized rate of return of about 7%, which was in line with the company's growth. Because remember, there is some volatility at the growth here, but you ended up with a very strong distribution policy. Now, once the stock got undervalued, especially after COVID, this was a really good time to be buying the stock because here we had a price to operating cash flow of 4.88. And from this point of view, we ended up getting over 23%. So I've made this point, and I try to make this point over and over again. Valuation matters, and valuation matters a lot. But this limited partnership is currently trading an evaluation that's below its typical norm. The normal price to operating cash flow has, over this long time frame, has been about 10. Looking at the last few years, actually, let me reduce that again. Looking at the last few years, we've had a price to operating cash flow of about 7.4, and it's just a tad over that right now. But the point is, it's close enough that it's still in value. Looking to the future of enterprise products, it is expected to grow. I'm going to use the normal multiple of cash flow here. It is expected to grow about 4% a year, and this would imply a very healthy 6.7% annualized rate of return if it traded at the 7.4. If it maintained its 8.21 operating cash flow, or say maybe a little higher, squeak out a little bit more of a rate of return. Now, let me talk about this a little bit because I want you guys, you can get a 13% rate of return. This calculator that FastGraphs provides allows you to do what-if scenarios. Okay, that's the point. So if we go to operating earnings and use that as a valuation requirement, we're expected to grow earnings at about 5%, and that's been the normal 5-year price to earnings number. And so it's currently trading at a blended PE of 11.7. So it's slightly higher, but I want you to notice the 4 orange lines here. This is the valuation corridor. Like I like to explain to people, I know this chart is wrong, but it allows me to make some calculations assessing different levels of risk and valuation. So if the stock was trading at 11.7 PE, that would be pretty close. Here's 11.97 right here. We could end up making 12% a year. Okay, so that's what if it did. What if the PE fell down to 8.7, which it has done in the past? Then the rate of return would be very low. But keep in mind, we do have our annual rate of return because we'd have some capital loss potential. So we can run these various what-if scenarios when we're using this graphic tool and then basically get a good assessment of what we might expect from investing in the stock going forward. And I think that's very, very important. Now, when you take a long-term view at this company, the real stable thing here is the continuously rising dividend. in spite of the fact that operating earnings have been essentially all over the place, if you will. They've been rising and falling. But if I go into the fiscal fitness section here, a couple of things I want to look at. You can see their debt to equity. They've maintained a debt to equity of about just slightly over 100%. Their return on invested capital has been healthy in the 10% range. So it has double-digit returns on invested capital. And remember, they're always investing their capital. It has pretty healthy, very healthy, actually, in my view, returns on equity of over 20%. I like that. And then return on assets, and the company's continuously forced to add assets, has been over 7.89%. Okay, now from a margin point of view, and I'm only looking at the more recent years here, the company's been generating a gross margin of over 12%, an operating margin of just under 12%, and a net margin of almost 10.5%. Those are very healthy margins for this company in this industry. Their sales revenue has basically for the last 5 years have been growing at around 20% a year. Their operating cash flow being greater than their net income has also been reasonably healthy. That's the red bar above it. Again, but their free cash flow covering the dividend doesn't really always foot the bill. That's the nature of the beast because of what I mentioned to you earlier. But now if I also go into fund graphs here and look a little deeper, we can look at some things here that are kind of interesting. I want to go into the ratios, all right, because the ratios are pretty important with a company like this. And let's go into price to valuation ratios. We looked at all these things already, and the company's reasonably healthy in all these areas. But the liquidity ratios are also very, very important when you're looking at a company. Their current ratio is 1, and I consider that very excellent. Their current ratio is over 1, which is considered very healthy. Their quick ratio is healthy at 0.68 or 0.74. So the company does maintain some good liquidity ratios. I also want to point out that from a standpoint of going into their per share data here, and let's look at the balance sheet a little bit. The company's short-term debt is minimal, which means there's not a big threat they can pay their debt. Most of their debt is actually long-term debt. I do want to make that clear because the company simply borrows for the long term, has very stable cash flows, and they're not as immune to the fluctuations in commodity prices and things because they basically do their business on a contractual basis. So all in all, when I look at this company now, I think you're looking at it still, even from an earnings point of view, is trading at one of the lowest valuations it's historically traded at. If you're looking at it just to review everything from an operating cash flow basis, it's also trading since COVID, is trading at some very low valuations. If you're looking at it from a standpoint of other cash flow or near cash flow metrics like EBITDA, it's trading at one of the lower EBITDA ratios that it's ever traded at. It's offering a 6.7% yield, current yield, and the yield has grown. And now if we look at this from just the standpoint of when the stock has been inexpensive here, if you will, after COVID. So I'm going to shorten it by 1 year here and look at the performance. This is the reason why you want to invest in the stock. Okay, we're looking at a yield of 9.19% has grown to over 10% just in these last 4 or 5 years. But if I expand this a little bit, I do want you to note that the yield on cost here in 2018 would have been 6.47%. That's very close to what our yield is today. So if we invested at that level, we could see that the yield has increased to over 8% by 2025, expected over 2025. So the reason you want to invest in a stock like this, for income especially, is because they're raising their dividend every year and they're starting out at a relatively high yield. Now, the dividend growth is not as high as you'll find on some very faster growing dividends, but you get high yield here, a lot of safety. It's an A-rated company. It's got manageable debt and a capital structure. It's got ample and very stable cash flows to pay that. So all in all, if you're looking for an income vehicle, I believe enterprise products partnerships would really fit the bill. Now, you do have to take into consideration things like you want to make sure you understand your taxes. You can have unrelated business income taxes. depending on what kind of account you put the product in. So I would check with your tax advisors. No free lunch out here. You get a very high yield and a growing yield from the potential to continue to see that dividend growing over time. But it's a product or an investment, if you will, that I think fits a specific need. If you're looking for higher income in today's world with interest rates where they are, and you're looking for the ability for that income to grow, plus have the opportunity for a little capital appreciation, then I think looking at Enterprise Products Partners makes a lot of sense. Anyway, this has been Chuck Carnevale, co-founder of FastGraphs. Thanks for watching. If you enjoyed this video, give me a like, ring the bell, join the channel, ring the bell so you get access to future videos like this. Join our YouTube channel if you haven't already, and take a look at subscribing to FastGrowth. It allows you to think your way through the investment process by presenting essential fundamentals at a glance, and it can save you a lot of time, a lot of effort, and a lot of energy by organizing things so that in a very simple, straightforward, factual manner that can help you be better long-term investors. I like to call it the value investor's best friend, and I wouldn't even consider investing in stocks without the benefits that FastGraphs offers. Thanks for watching.